Want to know if a stock is overpriced or a potential bargain? It starts with understanding one number. The PE ratio, or price to earnings ratio, tells you how much investors are paying for $1 of a company's earnings. Here's how it works. You take the current stock price and divide it by earnings per share. If a company has a PE of 15, that means investors are paying $15 for every $1 the company earns. So what's considered a high or low PE? A high PE is 30, 50, or even 100 plus. And this usually means investors expect big future growth. You'll see this in tech stocks and bio stocks. Take Tesla, for example. Tesla is traded at PE ratios of above 100. Why? Because investors believe the company's future growth will be explosive. But a high PE can also mean that a stock is considered overvalued. Let's look at a low PE, which is under 15. That might mean a stock is undervalued, or it could be a warning sign of low growth, high debt, or management issues. For example, AT&T might trade at a PE of 6 or 7. That might look cheap, right? But it's also struggling with debt and limited growth. Now here's the twist, and this is called forward PE. This uses projected earnings instead of past earnings. To calculate forward PE, you take the current stock price and divide it by the estimated future earnings. So why does this matter? If the forward PE is lower than the current PE, analysts expect earnings to grow. That is usually a good sign. If it's higher, this could mean analysts expect earnings to fall, and that's a red flag. So let's break down two examples. Apple has a current PE of 28, and it has a forward PE of 25. That means analysts expect Apple's earnings to grow moving forward. Now let's look at Verizon. Verizon has a current PE of 8 and has a forward PE of 8.5. That slight bump signals flat or even declining earnings. You use forward PE and PE to compare companies within the same industry. Don't compare Apple's PE to a utility company's PE. That's apples to oranges, literally. But it's going to give you misleading signals. Also, PE is useless if the company has no earnings. You'll typically see it listed as NA in this case. A couple pro tips before you go. Don't rely on PE alone. You have to pair it with the PEG ratio, debt levels, and cash flow. And I'll be making videos on these, so be sure to hit follow so you catch those. High growth stocks will always look expensive when looking at the PE ratio. This doesn't mean that they're bad buys. In low PE stocks, they're not always deals, some are value traps. So the bottom line is, PE tells you how expensive a stock is based on profits. Forward PE tells you what the market expects next. Use it right and you'll stop overpaying and maybe uncover a few hidden gems. If you're serious about learning how to read stocks the right way, hit that follow button, save this video, and share it with somebody who needs to hear this.